Hello, everyone. Thanks a lot for coming into this, for the people who are here in presence for the very rainy afternoon in London. I'm Giovanni, co-founder and CEO of Moneyfarm. With me, we have Richard, our Chief Investment Officer, and Jason Chapman, which I'm going to introduce very soon. So today, we want to talk about our strategic asset allocation for 2026. It's a very important process, is one of the cornerstones of our investment process. And I'm really glad, as every year, to come back and explain what is our view, what we've learned in 2025, what is our view for 2026, and also what is our tactical outlook for 2026. We're going to follow up with the questions. So for the people who are following us online, you can ask the question in Zoom, or in presence, we can ask the question directly at the end. So again, thanks again for everyone participating, and I hope you'll find interesting and give you a better insight on what we think. So let me start with the reason why we started the business in the first place. So our purpose as Moneyfarm as a company is to make finance simple and accessible. Accessibility has a broad sense for us. So it doesn't just mean giving you the best possible platform, but is also meaning reducing all the complexities in making investment more accessible. So giving you advice, guidance, and really solution that helps you achieve your goals. At Moneyfarm, our vision since the beginning has been to combine things. We wanted to combine technology, expertise, and passion, focusing on what we believe are three blocks for long-term investment success, which is access, advice, and low cost. Ultimately, what we want to deliver to you is best-in-class investment solutions. So we really want to provide you with choices, as well as the ability to delegate a trusted counterparty to make the money work harder for you to achieve your objective. So Moneyfarm today has 6.3 billion of AUM. We have about 220 people divided between Italy and the UK. I think in the last few years, for those of you who have been customers for a long time, I hope you have seen an expansion of our offering. We started with wealth management and discretionary investment offering, as well as guidance and advice. But now we have pension consolidation in particular. We have share investing, our DIY proposition, which we launched in the UK a couple of years ago, and a saving proposition, which we launched at the beginning of the year. So our goal is to really become your total wealth partner, so really help you achieve your objective across all your investment needs. So let's zoom out a second to talk about 2025. 2025 has been a remarkable year. The market has performed very strongly, with the exception of global government bonds. Most of the asset classes has been very significant performance, and our portfolios have performed well. As you can see from the chart, we attract with the right risk level the biggest MSCI Global, which is the biggest equity index for 2025. We have developed now a consistent philosophy, working with Richard for the last 7 years and the team. We have delivered a strong track record. You can see from these two charts on the right-hand side. The first one shows our percentile rank across the peers in the UK. We have 100% top quartile for all of our strategies in the UK, which we think is a remarkable goal over 3 years, and 80% over 5 years, as well as our relative performance across the various buckets over 3, 5, and 10 years. We monitor ourselves quite closely, and both myself and Richard sits in the investment committee, and we look at this data very frequently to really make sure we are doing the right choices. And I think so far, consistent philosophy and process have driven what we believe continue to be a very solid track record. Last couple of years, we generated almost 778 million of performance for our customers. I think this is a remarkable number for me, because it really is a testament to all the work that we do, and ultimately is what we want to deliver for you. And this means, goals, means, objective, family money. So it's really the impact that I think as a company, we're very proud we can generate our customer across the years. The business has grown significantly. If you can see from here, 2 years ago, we were managing 3.7 billion. Now we have 6.3 billion of assets. I mean, again, it's also, for me, a measure of how much all of you trust us and what is the success of the model going forward. So 2025, if we go back to the beginning, when Trump just was announced into office, the market was extremely positive. This chart is a bit complicated, but show you the positioning of the biggest fund management houses. And if they go high, it means they're very, very exposed to equity and they have low cash position. And you can see that Trump 2.0 pretty much made everybody positive about the success of 2025. I remember we were coming from a couple of years of extremely solid performances as well. So there was some concerns pre-Trump that 2025 could have been a more muted market cycle. Then everything unraveled very, very quickly. On April, Trump announced this extreme tariff shock, which was very unexpected, and the S&P index fell with the second largest daily point loss ever, while the Nasdaq fell the largest point loss in its history. So you can see how the mood completely changed from effectively pretty much one day to the next. Volatility has spiked. You can see on the left-hand side, the black line shows you the volatility versus the Standard & Poor index. And I think all of us were asking us, what we should do. Is this going to really impact the long-term performances? And I think the early consensus was actually that was quite a negative thing because tariff was inflationary, was badly handled, and I think that completely changed the market narrative in a matter of weeks. But actually, 2025, the market has been extremely resilient, rising through a year of continuous shock. From Liberation Day, then Israel strikes Iran, so all the tension in the Middle East, US-China tariff war, US government shutdown, the attack on the Fed independence. So it's been an incredible busy market for news cycle and things that were happening, which begs the question to us, what does it really matter? And I think this is also one of the reasons I hope you in a sense entrust the money to us and take our guidance, because our job actually became more complex in a year like 2025, which is extremely amount of noise. So the question that we need to ask ourselves every day is, what is signal and what is noise? So I'm taking this from a great book, which effectively tells you that the signal is the truth, but the problem with the noise is what really distract us from the truth. So it's not just about being able to filter that out, but it's doing a very active choice on what do you want to focus on, not to go, and spend time sideways on things that actually doesn't matter. 2025 has been a year of remarkable noise, and I think we have, experienced probably an amount of like this, honestly, not in the last 15, 20 years that I've been working in this industry. A good example of noise is this, which is a nice story to tell, because, this is a question that probably all of us will reply yes. So will we invest in a strategy that is correct 67% of the time? Let's just remember that the biggest hedge fund aim to be correct maybe 51% of the time. So this sounds like a remarkable proposition. The reality is that this is a strategy which was called the Super Bowl indicator, which was basically developed in 1978 by this New York Times copywriter, sports writer. And it was saying that every time the National Football Conference representative was winning, then the market for the S&P will rally. On the opposite side, if the AFC, so the American Football Conference, was winning, then it was signal a bear market. This is a great example where you see the gray chart, pretty much this is correct 67% of the time. Of course, it has a lot of accuracy in the past and absolutely zero predictive power in the future. And going back to this great guy who wrote this book calling The Signal and the Noise, is like our instinct is to really recognize pattern. It's so fundamental that we sometimes see them where they don't exist. And I think this has been pretty much our job in 2025, meeting 3 times a week with the investment team saying, is it signal or is it a noise? Are we seeing a pattern that doesn't really matter, it doesn't exist? And it's a fundamental challenge which is actually has been accelerated in the last few years. So I think it's really, really important to go back to understand and focus on what are the things that really matters, that can impact the stock market, that can impact the economy, and what are really the signals. So what we believe are the signals. And again, I'm giving you a very high-level view, and Richard will elaborate with much more in detail. For us, there is a few signals. One, the US debt, that's a fact. It's, we're talking about 38 trillion of debt, 138% of GDP. This is massive. It's not good. It's sustainable, not sustainable, or when it's going to become unsustainable it's a very difficult question to answer, but in reality, it is a fact that it's something that we have to watch very, very carefully. Technology disruption is here. I mean, we can argue how long it's going to take for AI to really impact productivity, but you can honestly already see now in London, maybe you have noticed some Waymo cars that are driving around. Next year, they're going to start driverless car in London. So the question is really more than the when rather than the if. And I think this is, again, another very important question that we keep asking ourselves very, very often. US CapEx, so the big tech companies, so-called hyperscaler, are going to spend this year $700 billion of CapEx, which will have a fundamental impact in terms of the stock market and particularly the productivity and GDP for the US. How much these CapEx are going to return in terms of ROI, it's going to be, or return on investment, it's going to be very, very difficult to say, but it's one of the things, again, where we want to focus on and looking at it. Fiscal expansion, 2.25 trillion added to the US GDP in 2026, thanks to the Trump Big Beautiful Bill. I think, again, another point that you cannot underestimate the impact that this will have in the market and the positive tailwind that it will have on the US economy. On the other side, we have the regulation, another positive tailwind. And on the less positive side, we have what is called changing world order. Maybe some of you have seen the great speech by Mark Carney in Davos, which outline how effectively, we can complain, but we cannot avoid the fact that we have to operate in a different world order and adjust. And I think this is a fundamental topic also for, where do we put the capital to work? How do we invest the money? How do we diversify across the various geographies and so on? Finally, we live in Europe, at least geographically speaking, and this is a problem because the reality is that Europe needs to get its act together. I think everybody knows what needs to be done. The point is making sure it gets done. And I think this is another fundamental point that maybe not directly related to the equity market, actually, in the very short term, but it's one of the things that we believe are the signal that we should continue to look at. So we remain very constructive. I think Richard again is gonna go in the detail. This shows our current portfolio's positioning versus the strategic asset allocation. For us, the SAA is a moment to reflect, step back and look at the more longer time horizon, and you can see that equities and government bonds and investment grade, where actually in commodities are positioned overweight against our SAA for 2026. Again, we want to be direct, we want to be very precise. We're not going to always be right, but at least give you a precise insight of what is our thinking and why. So going back to the point, what is the signal and what is the noise? This is our job. I think it's what I hope you guys are also, paying us for. And it's really, I think it's become more challenging, I have to say, during 2025 to reduce the noise. But I think it's also what makes this very interesting and exciting, doing this every day. Changing gears. So what's next for Moneyfarm in 2026? So we want to continue to grow and optimize. So this is a slide that represents what we believe is our focus. You can see on the right hand side, our winning aspiration is deliver best in class investment outcomes. This is the goal of the company. This is the same document that we share with all our employees, and we focus on that, and we focus on revenue growth because we want to grow, but we focus also on customer success and platform performance. And I think we spent the last couple of years enhancing the proposition, adding, you know, DIY investment, share investment, cash eyes, etc., etc. So for us, 2026 is more of a way to refine and improve, also to deliver the best possible experience we can give. We were very happy in 2025. It's been a very good year for us. We delivered 356 million of positive performance. Again, you know, customer outcome sits on top of what we care about. We got over 850 million of net new money on the platform. This is the measure of how much people trust us. It's a great achievement for us. It's a lot of money, as you can imagine, and we deliver portfolio return. So overall, we are happy about 2025. I hope that you are also happy, customer, in 2025, but then we're gonna also here to take your feedback. Specifically, what can you expect in terms of new things in 2026? We want to continue to optimize the platform, so we're investing a lot of money in technology and infrastructure to deliver, you know, better customer experience, but also lower trading cost. If some of you as a pension product, you will see that we are in the process of migrating the pension to a product which is more efficient. That's, I think, it's a year and a half of work that you are seeing, you know, the evidence of it today. But, you know, pretty much everything we generate and more, we are investing into improving our service and our proposition. We want to, you know, put a bit more attention on the DIY proposition, so our share investing platform. So we launched a complete do-it-yourself proposition where you can buy stocks, bonds, mutual funds, since October, also US shares. We haven't advertised that a lot, but we do think that, you know, even on top of our discretionary core modeling, some of you may want to have direct exposure into ETF, mutual funds, or maybe even single stocks, and we want to be able to facilitate that. 2026, we definitely want to talk more about this now that the product is complete. We're gonna also work on expanding our range of investment option in two ways. On one side, we see a big opportunity into income, and generally speaking, how do we generate yield? So a good return with low volatility, effectively looking at the short part of the interest rate curve. And we're gonna launch an enhanced yield proposition very soon, in the next month, where hopefully you can have a better than cash return, but with similar level of risk and volatility. As well as we are thinking a bit more medium term of, you know, the market has been going very, very positive for the last 3 years. We think 2026, particularly the first half, is definitely continuing to be positive, but, you know, we want to try to get access to the correlated sources of return. So investment return and product that might also perform well in a different market environment. This is more complicated to do it than to say it, but we're working hard to ideally, you know, launch something for you during the course of Q2 this year. So again, a lot of things that are happening. You know, Moneyfarm, we try to keep the ambition high, so we might not end up doing everything, but we're gonna definitely push and go into this further direction. Finally, let me please take the opportunity to introduce Jason Chapman. We have expanded our leadership team in the UK, and I think Jason came through the acquisition of Willis Owen, a business that we acquired during the course of 2025. And I think it's really great to have somebody who can be present in the UK on top of Chris and the team, demonstrate leadership, and keep also the company focused on our UK strategy with competence and dynamism. So, Jason, over to you for a quick intro.
You can always tell how important you are by the amount of slides you get to present. And I've got one, which is this one, and it's not meant to enhance my history. It's just to tell you that every business I've ever worked in, my role has been to make sure the customer is looked after. So I'm new too, and I met some new customers during the drinks beforehand. It's great to be here. I think it's a fantastic business. Willis Owen was a a business where I was a CEO, and as Gio alluded to, it was acquired last year, and it was a business that created a proposition for customers to buy their own funds, ETFs, investment trusts, etc. But I did find, having had a history in advice, that you get to a point where customers need a bit more help. They need a bit more support. They need a kind of overlay. And if you keep an eye on where the FCA and the Treasury are going with this type of thing, they're looking at supporting customers more with some options to give customers a better idea of what those products should work, and how those products should work for them. So I'm really, really interested in joining up what Moneyfarm does today, perhaps what Willis Owen did yesterday, in a way that allowed customers to buy products that kind of went around their core portfolio, but also how can we help customers more in terms of getting to the right outcome and that journey with them. So I'm delighted to be here, delighted to meet some of you guys, perhaps afterwards, and hear your experiences. Gio mentioned in his presentation about customer. One of the key things for me is to make sure that whatever we do, whatever products we produce, whatever propositions we land, they're right for the UK customer, and that's my job. So I look forward to talking to you at some point. Thank you, Gio.
So now the real meat for the event, which is Richard, our Chief Investment Officer, now has been with Moneyfarm for over 7 years, maybe 8, 9. Okay, so we've been partnering, and I sit in the investment committee, and I actually got the job before Richard, so we've been working very, very closely together. So I leave it to him to go through the where we think 2025 and 2026 is going to end up. Thank you.
Fantastic. Great. Good evening, everybody. Thank you for joining us. I'm going to do 3 things this evening. I'll talk a little bit about 2025, build on some of the comments that Giovanni already made. I'll talk about the strategic asset allocation process, which is a long-term process, as Giovanni mentioned, and is really an attempt for us to take a step back and try and kind of tune out some of the noise. And as he mentioned, there was an awful lot of noise in 2025. And then finally, to dive back into it and think about 2026, think about a shorter time horizon, what we think we can expect to see, the impact, and really how we think about positioning for that. So just turning to 2025, key message is really a better year than we might have expected, particularly after the volatility and the announcements regarding US tariffs. Strong performance in the end from equities, particularly outside the United States. Obviously, we've gotten used to, in recent years, US equities really outperforming the rest of the world. 2025 was a reminder of the value of global exposure. You saw strong performance, particularly in emerging markets in Europe and the UK. So really a reminder of the importance of having a kind of a broad toolkit. And then finally, the other part of it that I guess caught a lot of our attentions was a really strong performance in gold. And a little bit of an interesting dichotomy there, because gold, traditionally an asset that people think of as being a safe haven asset, something you go to when nothing else is really doing very well, but it came at a time when actually equities, the riskier part of financial markets, performed pretty well. So speaking perhaps to some of the complexities around financial markets and investing in 2025. So now just to dig into some of those things in a little bit more detail. This is a measure of political uncertainty in the United States. It really tracks newspapers, and you can see that after a relatively quiet period during the Biden administration, you saw a pretty sharp increase with the incoming Trump administration, really hitting a peak, at least for now, in the second quarter around trade. But certainly settling it perhaps at a more elevated level than we had seen for some time. And the question, and one of the challenges for us as investors is again, going back to the signal and the noise theme, is how much to listen to that, how to break out the headlines. And this administration, I think, is particularly adept at driving headlines, and decide really what is important for financial assets, what matters for cash flows, what matters for earnings, matters for risk, and how do we manage through that. So just to kind of try and quantify it, this is a chart from Bloomberg around US trade barriers. You can see a steady decline from the 1920s to 30s, and a long period of relatively low tariffs through most of the 21st century up until this point, and then a really sharp spike. But it's important to remember that the short sort of 15% trade tariff is much lower than some of the numbers we saw very briefly in April and May, when the United States and China had put 100% tariffs on a large proportion of their exports. So it looks like a big jump, but perhaps far lower than what we might have expected or might have feared around April 20th, April 30th of last year. So where did we see these tariffs appear in the data, in the macro numbers, in the numbers that actually we think drive financial assets? This is a chart of US tariff revenues, and clearly they've picked up, right? The US, somebody is paying these tariffs, US importers, we think, for the most part. And the United States government is clearly collecting money on a regular basis. It's interesting, though, to see that in the last couple of months, you saw it begin to drift off. And we'll look at trade flows in a little bit more detail in a second. But clearly, US importers or somebody is paying these tariffs. This just turning to growth. If you just looked at the growth rates for the US, for the UK and the Eurozone, you don't see a particular step change, right? So far, at least, we could say that tariffs haven't really appeared in the growth numbers. US growth was a bit slower in the first quarter, but has sort of reaccelerated a little bit in the second, third quarters and into the fourth quarter of the year. Europe and the UK growing more slowly, but not seeing a material shift as a result of some of the turmoil that dominated the headlines. We did see trade relationships begin to reorder. This is, to me, is a very interesting chart. It shows Chinese exports in aggregate and for the United States. And you see China, the dark line is showing Chinese exports continuing to grow throughout the year, reaching new highs, but Chinese exports to the US really dropping quite sharply. Now, some of this, it may have been transshipment through other countries, but again, it's a sign for us that these tariffs have not disappeared. They are having a material impact on trade flows and on trade dynamics, and we think that will continue over the coming years. And what looks like a relatively more muted reaction over 1 year may be more profound in the longer term. And we really need to think about what that means for growth, for investment. Where do companies choose to invest? What are the implications for corporate earnings? And how should we think about that from a portfolio construction perspective? In terms of inflation, it was said, and rightly so, that tariffs typically should be inflationary, at least on a one-off basis. These are annual inflation rates for Europe, the UK, and the US. And again, you don't see a particular spike here. It seems that for now, at least, these economies have been able to digest inflation, or digest the impact of tariffs on inflation perhaps more effectively than we might have feared. Again, you could say that inflation would have been lower, but inflation isn't at 2% which is the long-term central bank target in the US or the UK, but is not too far away. In the Eurozone, it's actually got there. But so far, one of the key concerns back in April was that we would see a very big spike in inflation, and that really hasn't come through. And that's part of the reason we think why financial markets have reacted more positively than we might have feared. So just to go back to a version of a chart that Giovanni showed earlier, you can see the impact of tariffs in April and May, a very sharp sell-off, and then a relatively quick recovery as you began to get some sort of a modus operandi that was a little bit better than we might have feared. Equities generally performed well. Government bonds a little bit less so. Better if you hedge the currency, as this chart shows. And commodities, primarily driven by gold, held up pretty well. So then just thinking about digging into some of the drivers of equities, this is looking at expected earnings growth in a range of regions for 2025 over the course of the year. So it's really tracking the changes in expectations. What you saw at the start of the year was pretty robust expectations for the US and emerging markets in double digits. Europe and the UK a little bit more muted. You saw downgrades as analysts feared for sort of future growth around tariffs, but actually you saw in general a recovery in the second half of the year. The notable exception there was actually in Europe, where you saw continued downgrades in earnings, and we'll explore that in a little bit more detail. But again, at the end of the day, the interesting part there was that it didn't prevent European equities from having a pretty strong year. So the underlying expectations were pretty good, even though actually, earnings growth in Europe proved to be much weaker than we might have hoped at the start of 2025. And then just to come back to the last point, the danger is you say none of this mattered, it made no difference to anything. And that's not quite true. So this is a chart looking at the returns of the European index, equity index overall, European defense and European autos. And what you see is European defense performed extremely well last year. Geopolitics clearly driving this, concerns about Russia and Ukraine, concerns about the US commitment to NATO, expectations that European companies or countries would need to spend far more on defense than they had been doing up until this point. And that was reflected in expectations and in returns. Similarly, you see a relatively muted performance out of European autos. We think, going back to some extent to the trade flows argument, China perhaps sending more of its autos to Europe, perhaps putting pressure on European businesses a little bit more than in the past, as it looked for new outlets for exports. So the geopolitics that we talk about, there's a danger that you underplay it because 2025 was ultimately a pretty good year for financial markets. But we are seeing changes. We did see changes last year, and we may see more of that in the future. And so when we think about portfolios and portfolio construction, we need to think about what that means for those long-term trade flows, those long-term profit flows, and where they're most likely to come. As Giovanni mentioned, we had a pretty solid year. I'm not going to spend too much time on that, except to say that obviously we've come into 2026 on the back of 3 pretty strong years for markets and for portfolios. Let me take a breath for a second and talk about the strategic asset allocation process. Now, what is it? Towards the end of each year, we try and take a step back and think about long-term returns. Think about what markets and economies might do over a 10-year time period. And we think about those long-term expected returns, and we really try and go back to sort of first principles, right? What matters? How fast is the economy growing? What's inflation? How does that translate into corporate profits? And what are starting valuations? And it is by design a fairly mechanical process. The idea is to say, to try and remove some of the behavioral biases, some of the noise that kind of affects us on a day-to-day basis, and say, if we think about this in a fairly mechanical way, what does it mean for long-term returns? And it's interesting, in some ways, it's easier to forecast over a 10-year time frame than it is over a 1-year time frame. All of the idiosyncrasies and the noise can somehow average out over that longer time period. So when we think about those long-term returns, it is a fairly mechanical process. It may not say very much about what we expect or what could happen over the 12-month period, but it can be a reasonable indication of the direction of travel over the longer term. So that's the approach, and to get to sort of a couple of punchlines, this is where we kind of come out in terms of long-term returns for a range of asset classes. And there are a couple of points to make here. The first is that actually the long-term returns don't look too bad. And I'll put these in historical context in a little bit. The second point to make, particularly I would say on the fixed income side, where given where inflation is, you can now, we think, generate decent real returns out of bonds, even government bonds. And that's important when we think about multi-asset portfolios and about how to construct, a decent real return for our clients, which is ultimately one of our key goals. The second point is that you do still see higher risk asset classes giving you a better return. Emerging market debt, global equities, they still give you a better return, which is what you would hope for. The third point, though, is to say that those expected returns are lower than they've been over the last couple of years. And that's perhaps to be expected. You've seen a couple of very strong years of equity returns. And so the long-term expected returns in this mechanical structure are lower than they might have been. Still solid, but lower than they have been. So let's try and put that in context. We've obviously been doing this for a while now, and we begin to have a little bit of a history bank that we can turn to and say, well, okay, how do these stack up versus the past? And again, there are a couple of points to make. The first is on the fixed income side, as has been the case for the last couple of years. Fixed income returns are much better than they were in 2021, 2020, early 2022, when bond yields were extremely low, and we saw the rather painful repricing of yields in 2022. The second point to make is that equity returns are not as low as they have been at certain points in the past, but as I said before, are lower than they were over the last couple of years. And that's something that we should keep in mind. Not because it means we should immediately sell equities, but because we should think about the shorter term drivers of return, about why these long-term returns may not necessarily appear over a tactical time horizon. But at the end of the day, when we think about the tools that we have to create or construct multi-asset portfolios, we remain pretty optimistic. We think we have a pretty broad toolkit. We think we can find sources of uncorrelated returns, and we think we're generally being paid to take risk in a lot of parts of the financial system. And that gives us some optimism about our ability to construct useful portfolios for our clients. Just briefly, these are this is the results of the process. These are the multi-asset portfolios running from a P2 with a relatively low equity exposure up to a P6 that is closer to sort of an 80% equity exposure. Outside of that, obviously, we have a purely fixed income line. We have a purely equity line, but this gives you a little bit of a flavor. But more interesting maybe is the chart that Giovanni showed earlier, comparing our current portfolio, the current SAA, firstly to where we were a year ago, and secondly, the strategic portfolios compared to our current client portfolios. Compared to a year ago, as I said, these portfolios have a little bit lower risk, have a little bit lower investment, a little bit lower equity risk, a little bit longer duration than they were a year ago. But in general, on the fixed income side and on the credit side, not a particular change. If you compare that to our current portfolios, what you see is that we are still more optimistic on the equity side than the long-term strategic portfolios. We're a bit less optimistic about duration, about buying long-dated government bonds. And generally, we prefer equities to the sort of middle part of the risk curve, by which I mean emerging market debt, high yield, where spreads we think are pretty tight relative to history. We currently prefer to take our more risky exposure in equities. I also wanted to do one more thing, which was to think about some key underlying assumptions, right? And in this process, because it's an important thing that we discuss a lot in the investment committee. And I put up a chart here of US corporate profits as a percentage of GDP. Now, this is national accounts. It's not just what you see in the S&P 500. But what you can see is that corporate earnings as a percent of GDP have risen pretty steadily in the US, and they're at a pretty high level versus history. And one of the underlying assumptions of the strategic process is that will sustain, that will continue. And there are a couple of moving parts there. One is typically you see corporate profits fall in a recession. The strategic process isn't expecting a recession. We, from a tactical perspective, aren't expecting a recession either. But it is an important assumption that we need to think about. The other, obviously, is around where wealth goes into an economy, right? And what we've seen over time, particularly in the US, but elsewhere as well, is that asset owners have really benefited. If you owned equities in the US, you were feeling pretty good about yourself in 2025. If you were in the lower income bracket, you were struggling a little bit more, and it's what often gets called a sort of a K-shaped economy, where there's a portion of people with exposure to high corporate profits who are benefiting, and people who are kind of living a bit more day to day who are struggling a bit more. That has political implications. It has policy implications. But it's something that we need to think about, not just on a strategic basis, but also on a tactical one. But I wanted to really highlight this as a reminder to ourselves, but also to you, about the underlying assumptions that we need to consider when we think not just about short-term returns, but also about the longer-term returns. So with that, let me turn to 2026. And I'll start by looking at valuations and then really think through earnings expectations, the impact of artificial intelligence, government bonds and government debt that Giovanni alluded to earlier. The first thing to say is global equities look relatively highly rated versus history. That doesn't suggest you're going to have an imminent decline, but it does suggest that expected returns should be lower going forward than they have been in the past. And that, broadly speaking, is consistent with the message from our strategic asset allocation process. But as we saw in that process, we continue to think you can get decent equity returns on an ongoing basis, just perhaps not as strong as you've seen over the last couple of years. Where is that coming from? This is a chart showing the forward price earnings ratio for the US, Europe, UK, and emerging markets. You can see the US equities are particularly highly rated versus their peers. And that's to a large extent, we think, because they've typically grown faster and they're more profitable if you look at an aggregate basis. But that valuation gap is something that we've kept an eye on and is one reason why we've continued to maintain a diversified equity exposure, even as the US equities have outperformed in the years prior, at least to 2025. Looking outside the US, you've seen a lot of re-rating. Those valuations in Europe and the UK and emerging markets have risen over the course of the last couple of years. They're not as high as they have been in the past, but we have seen a steady re-rating. But it's also worth noting, this is a comparison between US valuations and European valuations. And you saw this very steady outperformance of the US really from 2016 onwards. But actually in 2025, you saw the US derate a little bit, the valuation gap closed. And that's partly because European equities, for instance, did better, but also because US equities grew faster. And so that valuation gap, US equity earnings grew faster, I should say. So that valuation gap is less pronounced than it was. And it's something we'll continue to monitor. We think you could see that gap close further. But we should also remember that the opportunity set in the US is extremely broad, that the exposure to technology and to some of these very fast-growing, very profitable businesses is significant. And so this is, I showed you a chart showing how earnings expectations for these markets shifted in 2025. This is the same chart really for 2026. And what you see again is pretty robust expectations. Double-digit earnings growth across pretty much all markets, Europe, emerging, UK, and the US, and it's reflected elsewhere as well. And it's an important driver for expected returns. If you see these earnings come through, we think that would be a relatively positive signal. And so it's something we'll continue to monitor quite closely. So far, the results that we've seen, mostly for the fourth quarter of last year, have been pretty good. It gives us some comfort that the expectations here are not too high. But if you were to come to the end of 26 and see double-digit earnings growth across these markets, that would be a pretty positive outcome. We think that would be consistent with positive equity returns, even with relatively higher starting valuations in some cases. Let's just turn to the fixed income side of it. This is a chart showing policy rates for the US, the UK, and the European Union. And you've seen policy rates come down really over the last year, 18 months, perhaps less quickly in the UK than we might have hoped. But really our expectation from here is that we think that the European Central Bank will not be cutting rates particularly aggressively, if at all, in 2026. We think there probably is some scope for policy rates to come down a little bit further in the UK and the US, but not by that much. There's an ongoing debate in the team, I would say, about the direction of inflation. I think overall we think that in the US and the UK, inflation probably struggles to get back towards 2%. It may not be you may not see a big acceleration from here in the way that I think some people feared, 8 months ago. But the 2% target is a struggle, but we don't think that central banks will be too dogmatic about trying to get there, and we think that there is some scope to see policy rates come down a little bit further, but not too much. And then just something to say, well, the question is not just about policy rates, but what we think that means for longer dated bonds. Again, if you're if you're looking for a mortgage and you're hoping to see those mortgage rates come down, they might come down a little bit, but we don't think by that much. Again, what did we see in 2025? Even as policy rates came down, these are 10-year yields for the US, the Germany, the UK, and I put Japan on there. Japan is very interesting. But again, in the US and the UK, you didn't see those yields come down particularly. You saw the curve, the difference between short-dated bonds and long-dated bond yields rise. On the one hand, that's healthy. We think that they should generally be positive. There were a number of years where that wasn't the case. There really wasn't much difference between a long-dated yield and a short-dated yield. And we're pleased to see that that's changed. But what it does mean is that just because you see policy rates come down doesn't necessarily mean that you're going to see longer-dated bond yields come down. In some respects, from a long-term perspective, we think that's good for us. It gives us opportunity to find higher returns potentially on further out in terms of longer-dated yields. But it is something that we continue to keep an eye on, not least because if we do see inflation begin to reaccelerate, then there's potential risk, we think, in terms of these longer dated yields. For now, we think that they're attractive. We don't expect to see them come down by that much. But for people with a long-term investors with a long time horizon, we think that there are some opportunities there. As Giovanni mentioned, government debt continues to be a focus of attention. This is the US, the UK, and Germany. This is gross debt to GDP. Germany obviously has managed its debt levels particularly well, but we think we're going to see those rise over time as the need for greater investment and greater defense spending kicks in. The US government continues to spend. It's been an important driver of growth. We think it'll be an important driver of growth in 2026. And for now, at least, investors continue to be prepared to support that, and we would expect that to continue to be the case this year as well. We don't expect to see any particular shock in terms of government debt or in terms of the willingness to buy government debt. But as we see those debt levels continue to rise, it becomes more of a question. The UK, as we've seen, is somewhere in the middle. Has its challenges, and we could talk much more about that. But the ability of the UK government to really to drive growth and to spend is we think a bit constrained given its status and the appetite of investors for UK paper. I wanted to say a couple of things about artificial intelligence. Where do we come out on this point? This chart is really showing the investment spending on data centers as a percentage of GDP in the US, and you see that it's drifted up over the decades, but has really begun to spike in the last couple of years, and we would expect that to continue. Obviously, the numbers that have been announced from some of these hyperscalers are enormous, $650–700 billion. Even if only a percentage of that is invested over the next 12 to 18 months, it's still a material driver for growth, and it has implications, we think, for resource allocation in terms of the availability of energy, and it also has important implications for their return on invested capital for some of these businesses. And you have to make some important assumptions about how quickly artificial intelligence, AI tools are adopted. So with that, one of the key questions from a macro perspective is how does this really reflect in the numbers? And this is a long-term chart of US productivity. And you can see a period of time in the 80s and 90s when it was really below trend. You saw that pick up in the early to mid 2000s, and you see it pick up again more aggressively, maybe even post-COVID. So there are a number of reasons for that, but we continue to think over the last couple of years that we're beginning to see some of the investments in technology, and even more specifically in AI, already beginning to show up in the numbers. So when we ask ourselves the question, oh, is this real? Is this something that's really going to impact in macro numbers, in corporates, in investment spending, in potentially in profitability? We think that the answer is yes. We think that that's potentially good news for companies and for equity owners. We acknowledge that there may be implications for employment. We think that there may be some discussions about taxation, about the right way to tax these types of businesses that are very low, have very low labor intensity. But in terms of whether we think we're seeing this in the numbers, we think we are. We think that there's a lot more to go. We think that these companies need to show those results to justify the investment that they're making. But so far, actually the results and the signs are quite positive, we think.
Richard, if I can just come in. Can you elaborate basically on whether you still think AI is a bubble or not, or think AI is a bubble or not?
Yeah. So the short answer is that at this point we don't, and there are a variety of reasons for that. We think that actually, if you look at valuations, and I'll try and break it down, it's an important question, and there could be a long answer for it. So we think if you look at starting valuations today, for instance, versus where you were in 2000, those valuations for the hyperscalers are lower. We think that the investment process for artificial intelligence is still in a relatively early stage, we think. We also believe that a lot of risk has been put into the private markets, right? If you look at the number of IPOs that have been launched for instance, in the US in the last couple of years compared to 99, 98, it's a far, far lower number. There were vast numbers of IPOs being launched in 99 and 2000. That number is very different. These companies, the likes of OpenAI and Anthropic, they are staying private for longer. We think that they will eventually probably come to market. That seems to be the signs. But a lot of the investment spending, a lot of the capital that they've needed has come from private markets rather than from public markets. That's a bit of a two-edged sword. It means that perhaps in the public markets there's been less opportunity for enthusiasm, but in the private markets, obviously those investors need to look for a return as well. So we don't think it is. But not thinking it is not the same as being blind to the possibility that it could be. Obviously, if you look back at history, at past periods of technological disruption, you think of the internet boom, you think of cable and fiber, you think of railways, you think of canals. There was always even when these proved to be transformative, there was a period of overinvestment and digestion, and so we're particularly mindful of that. So because we don't think we don't think it's a bubble today, we are constantly mindful of the possibility that history suggests that you should be very wary of it. What's the key? What's the key issue to consider is really, we think, this issue of adoption, right? Can AI in all of its various forms, move from being something that looks really cool when you play with it to actually something that becomes a core part of companies' business, of company operations, of the investments that corporates make. Obviously, we're seeing really big investment spending from the providers of this, but I think we need to see it from the consumers, and obviously that speaks to a lot of the discussion around software that we've seen over the last couple.
Just while I've got you, also geopolitics is obviously creating an enormous amount of impact across the globe. Tariffs, Trump, etc. We've got the midterms coming up this year. Starmer, recent news regarding back in the UK. How do we position ourselves with those types of events going on?
Yeah. So if you pull up the kind of conclude, let me get to the concluding slide, which will hopefully address some of that. Look, I think a couple of things. Let me answer the question directly, which is the second kind of last bullet point. Look, we think geopolitics will stay noisy. I think if you look back over the last few years, we would have been surprised by how little all of the geopolitical noise how little the impact has been on financial assets. and you mentioned that, you know, Ukraine, the Middle East, Iran, Venezuela, and there sometimes can be reasons for that. But you know, we think that the real, you know, issue behind this is one, that there has been some level of de-escalation. It hasn't expanded, although we might have feared that it would or could. The other is that the macro backdrop has remained pretty robust. Growth generally has been decent. Inflation hasn't spiked. You haven't seen, you know, for instance, commodity prices, you know, spike in response to events in the Middle East, speaking perhaps to a more diversified supply. And so we think that you know, barring an extreme tail event, that provided you see decent macro fundamentals, provided you continue to see decent corporate earnings and corporate profitability, we think that investors will continue to look through those geopolitics. But I would refer us back to the sort of the trade chart, which is that we do need to think about, even if there isn't the sort of, you know, the big direct impact, you know, the way in which the global economy is perhaps reforming, and the implications for that. And we, you know, I would point us again to the last bullet point there, which is really around diversification, and thinking about how to construct well-diversified portfolios, not just in terms of geography or in terms of sector, in terms of asset class, but really trying to think about ways we can get uncorrelated returns that we can use to build these multi-asset portfolios. Often easier said than done, but continues to be in perhaps a more fragmented world. We think that diversification will continue to play an even more important role than it has done. Beyond that, I would just say, look, the macro environment we think is solid in 2026. We think that long-term returns, they're lower than last year, but still pretty interesting for us. And we think that, you know, even if equity expectations are high, we think that the outlook remains pretty constructive. And with that, I'll close.
We just got one other question, sure. If we've got time, that's come through, which is around, I think it was on your slides, Gio, actually, protection for the market correction offering. Will this be an insurance-like service?
Yeah, so we are effectively experimenting with a few things. We have done you know, we have been studying this topic for actually quite a while, at least a couple of years. And the problem with, you know, buying protection is that fundamentally it is expensive. And the question is, when do you justify the cost with a view that it will actually make sense? I mean, we don't necessarily see volatility as a bad thing, although it's unpleasant for all of us to live through it. But if you have a long time horizon, it doesn't necessarily impact your return. So the willingness to spend this money on protection needs to be linked to a very precise view on the market environment. That's what makes it quite tricky. So insurance, we're thinking more of financial insurance rather than actual you know, insurances in physical insurance and others. But, and again, the real work we're trying to do, and we have been doing, it's really to understand where do we think we will recommend the cost benefit analysis of getting into that type of solutions.
And I think it's also important about managing expectations there as well, because if you want to cut all risk, then you have to give up most of the potential upside. Yeah. Right. So there's an expectation around, there's a question we should take, there's an expectation around how do we think about the trade-off between how much protection do we want to try and provide versus how much upside potentially do we want to give up.
There was one about thematics and portfolio doing well. Perhaps you'd like to finish on that.
Yes, that sounds excellent. So I thought I saw a question coming to me. I'm trying to answer. I thought I saw a question come up about, do we look back at the past long-term forecasts? The answer is that we do. Obviously, if you're looking over 10 years, you don't have that many points. I would say, though, that we are mindful that our equity forecasts have generally been conservative over the years from the strategic asset allocation. And so that is something that we present them as they are, but we are mindful that if we look back over a long time period, the most recent history, at least, then our equity forecast would have been, those long-term strategic forecasts would have been more conservative than what has been the case. On the thematics, yes, the thematic portfolios have done pretty well in 2025. I think we were particularly pleased that the multi-thematic portfolios that combined all of them did particularly well. So it wasn't simply a question of was it all technology driving this. No, we had a number of different themes. Some of the natural resources themes did well, as you might imagine. Our exposure to some of the defense themes also did particularly well. So that multi-trend portfolio did do well in 2025.
Any question from the audience or this?
I have just a general question about the ESG portfolios.
Yeah.
I think generally they sort of underperform the normal portfolios. Do you have a view on sort of how they're likely to fare over well, some of the main reasons for that, how they might likely to fare over the next, over the long term?
Yes.
We should repeat the question just for
yeah. So the question was around the ESG portfolios that have perhaps done not as well as the classic portfolios did in 2025, and how we think about that. I think it's an important question. It's something that we've spent a good amount of time thinking about. If you break down the differences in returns, some of it was the ESG portfolios have not had commodity exposure. They haven't had defense exposure, for instance, and those have been meaningful drivers. But there have also been other things that have driven that, and we've been looking at those portfolios to think about whether we can reduce the difference while still staying true to the ESG, staying true to the ESG philosophy. We think that there are things that we've been doing. If you've looked at the portfolio changes that we've made over the last kind of 4 or 5 months, we've been trying to do some of that. I think that the range of instruments is better than it was 4 or 5 years ago when we launched these portfolios. I guess the last thing I would say about that is in any given year we wouldn't necessarily worry if there was a gap between the two. You might expect that. I think that the thing that has made us less comfortable, perhaps investors as well, is that there's been a certain persistence over the last 2 or 3 years where the ESG portfolios have been persistently. They've been solid, but not quite as good as the classic portfolios, and that's something that we've looked at, and we've been trying to look for ways that we can close that gap while still staying true, as I say, to the ESG philosophy. And we think that there are things that we have done and we can continue to do.
I think we did that balancing literally
a couple of weeks ago, and that was an ongoing process.
It was an ongoing process, which probably started about 6 to 9 months ago, rethinking the exposure toward what we would call lower tracking error toward the classic. I mean, there's always going to be a trade-off, and I think that our belief that in the end of the day, most of you choose the ESG because of their quality from a value perspective. So performance is an element of that, but I think I would say we are mindful of that, and we've been working quite actively to try to close the tracking error while remaining true to the ESG principle over the last 6 to 9 months. Was I think a question of the hyperscaler. They dominate the S&P, 30% of probably all earning comes from there. How do we manage that?
Yes, look, I think we have a range of tools to manage that. When you look at our geographic exposure, we have perhaps less US equity exposure than if you looked at it on a global market cap weighted basis. We have in the past used an S&P 500 equal weighted, where all those stocks have the same weight regardless of their market cap. That's something else we can have in our toolkit. We have had exposure, for instance, to global value, which did particularly well last year, which is obviously much less exposed to some of these big hyperscalers. So I think that the ETF ecosystem has really developed a lot over the last few years, and so the range of tools that we have to try and manage that is much broader and deeper than it was. But the fact remains that they are large, they grow quickly, and they're highly profitable. And so we do, need to think about how how we put them into a portfolio, but we absolutely have the tools to manage that exposure and to make sure that our sizing is consistent with our view on those sectors.
There is one last question, but I think I can probably answer this myself.
Okay.
So the question was, is it now a good time to invest, top up, and put more money in my portfolio? So I think yes, absolutely. But Richard, perhaps you'd like to answer that on a non-advice basis.
Look, I mean, again, I would say three things probably. The first is, we are investing for the long term. We encourage all of our clients to take as long a long time frame as possible. That compounding effect is really what helps to build wealth over time, and we would encourage people to take as long a time horizon as they feel they can. Hopefully we've laid out the kind of the sort of the opportunities and the challenges that we see in the market at the moment. We continue to think that long-term returns are overall constructive. We see a lot of the risks. We also see a ton of interesting opportunities in both fixed income and equities from what is a particularly, I would say, dynamic environment. And then the last point to make is, obviously we run a range of different portfolios at different risk levels, and those, we think that for an individual client and customer, their specific circumstances are the most important, but we think we have an offering that can accommodate the very large majority of potential customers. So there will be a portfolio that we think is appropriate for you, and I would urge you to talk to your advisor and work out what that is.
Thank you very much, everyone.